Hey Bowtie Nation, Joseph Hogue here, and with inflation still creeping higher and wage gains slowing, passive income has never been more important. But all the passive income ideas you see here on YouTube have one thing in common. They are a lot of work. That's why I'm highlighting 7 passive income dividends you can count on to pay your bills. I'll reveal those 7 passive income stocks along with a few other investments for a portfolio yielding 7.25%, more than 5 times the market's average dividend yield. I'll show you how to find these and how to lock in that money every single month. Let's jump right into one of my favorite MLPs, Enterprise Product Partners, ticker EPD, with its 7.7% dividend yield. Now, MLPs, or Master Limited Partnerships, are special types of companies set up to own oil and gas pipelines and storage. They get a special tax break if almost all the profits are passed on through to investors, so it makes for some of the highest dividends you're going to find in the market. EPD is a fully integrated midstream company, meaning it has exposure to everything between the explorers and the retailers, including 50,000 miles of pipeline, storage, gas processing, and chemicals. It's more diversified than most midstream energy companies and has the financial weight to leverage its size for higher returns. Return on invested capital has remained above 10% even in the worst collapse in oil prices, so you've got that dividend stock that you know you don't have to worry about. Now, the dividend growth on this one hasn't set the world on fire at just under 3% a year over the last 5, but the shares have produced a solid total return over 8%, and the company has just made its 25th consecutive year of dividend increases. With that fee income MLPs are known for, this is one you won't have to worry about as you collect that passive income. Our first passive income investment outside of dividend stocks is a bond investment I've been using lately. After the interest rate on Series I bonds fell to just over 5% this year, I needed a different fixed income return on my cash. I found it with the 7% yield on Worthy Bonds, a new platform with bonds backed by small business and short-term real estate loans. I started here with $500 to test it out, and the account earns interest on a daily basis. You can invest as little as $10 per bond, and best of all, you can withdraw all or some of the money anytime with no fees and no penalties. I can withdraw the bonds themselves or just the interest on the account, and it all goes right back into my bank account. Worthy also has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. And just in time for the holidays, give the power of compounding interest by gifting a bond. You just put in how many bonds of $10 each you want to gift and put in the receiver's email address. I'll leave a link to Worthy in the description below for more information. Use the link and you're going to get an exclusive deal I worked out for everyone out there in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That is a 20% return on top of the 7% interest rate, so look for that link below. I've been picking through the chaos in regional banks this year and found KeyCorp, ticker KEY, with its 6.3% dividend and upside potential. And just as investors were surprised at the hit to banks on higher interest rates, I think the market is going to be equally surprised at how will they come back when those rates start to fall next year. And KeyCorp is a smaller regional bank with branches throughout the Northeast and Northwest, and one of the few banks to see deposit growth over the last year, with total deposits now back up to before that crisis in March. That, along with rising interest margin, is helping the bank return its revenue to growth. KeyCorp also has a growing investment banking segment, something you usually don't see at these smaller regional banks. Now, that's going to help us smooth out the risk in the bank's traditional loan business and give this one more reliability even in hard times. And KeyCorp has only been increasing its dividend for 13 years. Like most banks, it cut to protect that cash flow in the 2008 crash, but it's come back for that dividend commitment, growing the dividend by nearly 4% a year over the last 5. Now, I'm mixing a group of non-stock investments in with our dividend stocks to create that broader passive income portfolio. But for these dividend stocks, I filtered for a set of criteria to make sure you could count on those payments. And first here, if you're going to be depending on these dividends to pay the bills, you need a stock with a reliability that won't let you down. You need to know that that check is coming. For example, when my wife wanted to take 4 years off work to attend nursing school, I called the bank to ask, well, was there some flexibility in our monthly payments? And all I got was... So first here, I filtered for dividend stocks with absolutely no cuts and at least 10 years of payments. They didn't have to pay every month because with enough dividend stocks, you're going to get a check every month anyway, but they did need that reliability of paying every quarter. To find this, I used the historical data tab on Yahoo Finance to find past dividend payments. You can change the time period here to max and then to show only dividends. You're going to see the stock's dividend history and that reliability in its payments. For example, I can see here all of KeyCorp's dividends. Here we see the most recent at 20 cents a share, and scrolling down that entire dividend history, we see payments back 36 years to 1987, including that last cut in 2009 after the financial crisis. But just paying a dividend every quarter isn't enough. A stock that doesn't grow its dividend means you might not be able to pay those bills in a couple of years as your bills get higher, but your dividends don't. That's why I also filtered for only dividend stocks that have increased their payments by at least 3% a year to beat inflation. And you can find this on Yahoo as well. Using that dividend history, we just divide the current quarterly payment by the payment 5 years ago. Here we see KeyCorp pays just over 20 cents a share now and paid 17 cents a share in the dividend 5 years ago. So that 20 cents divided by 17 cents gives us a total dividend growth of 20% over the period. But then to find the 5-year annual rate, we take this to the power of 0.2 and get a 3.8% annual dividend growth. Now this next stock, Leggett & Platt, ticker LEG, has had a tricky year, but this dividend king pays you nearly 7% to hold the stock while you wait for that price upside. Leggett is a global leader in manufactured components for home and auto, including bedding, furniture, flooring, and industrial parts. You see here in the product mix, more than 60% of sales are from that home segment, with nearly half from bedding. The company does have some diversification, though, through its 35% sales outside the US and 40% in the auto and industrial segments. Now, with housing market weakness on high mortgage rates and a slump in auto sales over the last year, earnings for the company have been hit hard. Sales and profits are expected lower this year, but to start rebounding next. That means the company may have to take on more debt to keep up its 51-year history of increasing the dividend, but there's no real long-term risk here. Shares are down from its 2021 peak, but you're going to collect that 7% cash flow while you wait and a good long-term price upside. Now, all you out there in the nation know I love real estate for passive income on rents. I've managed my own real estate rentals, though, and it is far from passive. That's why most of my real estate investments are now in platform investments and real estate investment trusts, like Realty Income, ticker O, the monthly dividend payer with 5.6% dividend yield. Realty Income is the only real estate investment trust in the Dividend Aristocrats Index and has posted 117 quarterly increases, a growth rate of 4.6% annually since 1994. In fact, if you had bought the shares in 1994 at that $8.30 each, you'd now be collecting over $3.06 a share in dividends each year. That's 36% yield on your original price. And while most of the company's properties are in retail space, it's all the defensive side of the industry with convenience stores, groceries, and drugstores, the kind that aren't going to be replaced by e-commerce. Now that means stable cash flows and a vacancy rate average of 98%, well above the REIT average at 94% vacancy, producing that consistent cash income. To add a little more growth to the portfolio, the company has started acquiring gaming and resort properties with its Wynn Resorts deal. It's a little more cyclical compared to the defensive retail properties it holds, but adds some cash flow growth as well to the stock. And REITs have had a tough time with rising interest rates, and the industry was down 25% last year. That makes it a great time, though, to add shares of Realty Income ahead of what could be a strong bounce when the Fed does start lowering its interest rates. We've still got 2 more passive income-paying dividend stocks left, but I want to get your input on this as well. Which would you prefer? These passive income investments where you just invest your money, then it's totally hands-off? Or the kind of passive income ideas that you have to build over time, spending no money, but that sweat equity that creates the cash flow? It's a question I've always struggled with, so let me know in the comments below. Which do you think is better passive income, an investment or a business idea to create that cash flow? Now, I hate that I have no control over the properties that go into a REIT, a real estate investment trust like Realty Income, and I miss owning those single-family rentals, so I've also started investing through Arrived Homes. Instead of investing in a fund of properties or a portfolio like with a REIT, on Arrived, you get to invest directly in individual rentals. Each investment is a separate LLC, so you have a direct investment in it. Arrived uses professional property managers to lease and maintain the properties, then passes rental income on directly to investors. You earn dividends on the rental income paid out every quarter, with dividends from 3 to 8% on the rent, and then price appreciation when the property is sold. You can invest as little as $100, and Arrived gives you all the information you need to analyze a property. You're going to find location information, the tenant leasing process, as well as what to expect in monthly rent. The returns calculator even helps you plan out your cash flow and total returns, with returns as high as 136% over the 5 to 7 year holding period. So I like Arrived as a complement to my REIT investing, giving me a little more involvement in those real estate investments and a higher return, but it's not for everyone. So I'm going to link to the platform in the description below to find out more. Now, one thing, the homes available for investment sell out fast, so make sure you click through and get on that notification list. I missed out on a lot of good properties for not being on that notice list, so look for the link below. We've got one more passive income dividend stock to highlight, my favorite long-term dividend payer with a 9.5% yield. But a new year means a new investing plan, and I've found 10 stocks that could be your best investments this year. Make sure to watch this video next for a step-by-step on how to invest this year and the 10 stocks I'm buying right now. Now, this next dividend stock may not be for everyone, but it is tough overlooking the 9.5% dividend yield on Altria Group, ticker MO. The owner of Marlboro brands in the United States is driving hard to a smoke-free future with a heated tobacco and pouch products, and has been able to keep its revenue consistent despite a years-long trend in lower cigarette volume. You can see here, even against an annual drop of 4% in cigarette volumes, the company has been able to stem that to just 1.7% on growth in its e-vapor and oral products. Altria also owns a 10% stake in beer maker Anheuser-Busch, worth $10 billion for some serious cash flow. Even on that continued drop in volume, Altria had the pricing power and the cash flow to pay down $1.1 billion in debt and still buy back $2.1 billion in shares and pay $6.4 billion in dividends. Get 7% on your cash plus a free bond with that exclusive offer and a link to Worthy below. Or click on the video to the right for your investing game plan and the 10 stocks I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.